Welcome back to the series of videos that explain how to complete the financial statement and analysis spreadsheet system. This spreadsheet is part of the University of Wisconsin Extension's Pulse program, and you can see the website to the Pulse program on the visual. There's also a website link to the Pulse program analysis articles, which go a lot deeper into some of the ways to do financial analysis. And finally, to the spreadsheet itself, the last link that's shown on this visual. My name is Kevin Bernhardt, and I'm both a farm management specialist for the University of Wisconsin Division of Extension, as well as a professor for the School of Agriculture at the University of Wisconsin-Platteville. This is the final video discussing how to analyze financial statements in order to discover the farm's financial story, and better yet, to have good information for making sound farm management decisions tomorrow morning after breakfast. Specifically in this video, we're going to talk about cost of production, the DuPont system for financial analysis, and sensitivity analysis. Like all these videos, we can only go so deep in video format because we just simply don't have enough time. But there's a lot of links to information that are shared here on the visual that you see currently, as well as others. So let's get started. Cost of production. It is often said that in the commodity world, commodity producers are price takers. And there's certainly a lot of truth to this. Producers can do something about getting premiums or maybe suffering discounts. They can also do something about pre-pricing their product by using futures markets, forward contracting, options, etc. But it is true, the ultimate cash price that's offered in the market is beyond the grasp of what the producer, the individual producer, can do to change that price. However, while producers may be price takers, they're not cost takers. So whether a commodity producer or even a value-added producer, the costs are a lot more within the control of management decisions. That makes them a very important metric to follow and a very important metric to make farm management decisions on tomorrow after breakfast. However, determining an accurate cost of production is fraught with challenges. First of all, which cost of production are we talking about? Cash cost of production, accrual cost of production? Are we including interest expenses in that? Are we including the gain loss on capital asset sales on that? Are we including income taxes? How about family living? There's lots of different variations of cost of production. All of them can be important in a management decision given the situation, but it's information that we need to know. So when you see cost of production articles in the newspaper or in the magazine, your first question should be, which cost of production are they talking about? Some deeper dive into this kind of information, this kind of discussion is shown on the visual. There's a link there to which cost of production, which is an article about these various kinds of cost of production. There's also one there to how to calculate, because that's another challenge for cost of production. If you have multiple enterprises, or if you have multiple products, and you're trying to get a cost of production for a specific product, how do you do that? So let's assume I have a third or maybe even half of my costs are for producing cash corn or cash soybeans, and I'm looking for a cost of production for milk. If I use all those costs for corn and soybeans and I force the cows to pay for it, it's going to give me a very large cost of production per unit sold per hundredweight. And that's not useful because I'm paying for all the corn costs and the soybean costs as well. So how to calculate cost of production is a challenge we'll talk a little bit about in this video, but you can do a much deeper dive into that by going to the link shown on the visual. And of course, how to use cost of production in analysis as well. The other link that's shown on the visual is to the DuPont system for financial analysis. So if you want to do some reading on that, it's shown there, but let's talk a little bit about that here as well. The DuPont system was created a long time ago, and it looks at the three primary levers of profitability. And this is true whether you're a dairy farm, you're a crop farm, or you're a shoe store, or you're a retail store. It doesn't make any difference. Every business has these three levers of profitability. The first lever is you have to work your assets to create gross revenues to start with. I can guarantee you that you won't be profitable if you don't create gross revenues coming into the door to begin with. We have a measure for that, and it's called the asset turnover ratio. So we can track that, compare it against industry standards, all those good things to see how we're doing at working our assets. The second lever is being efficient with our input practices and how much we're spending on inputs, such that we're keeping as much of that gross revenue that we originally created in our pocket after all expenses are paid. That efficiency can be measured by the operating profit margin ratio, and that gives us another measure that we can look at too for evaluating this lever of profitability. The final lever of profitability is using somebody else's money to create more profitable activities on our farm. That can be found as it's a derivative of the debt to asset ratio. The actual ratio is total assets divided by total equity that we'll be using, but it's a leverage ratio. So it's leveraging our debt financing to create more profitable activities. So we'll talk about that lever as well. Now here's the visual that you now see sort of is the same three levers: asset turnover, the operating profit margin ratio, and the leverage ratio. Let's see how those work together to create profits. Well, I can take the asset turnover ratio and multiply it times the operating profit margin ratio, and the result is the return on assets. The return on assets is one of the more popular profit metrics to measure our farms, both against standards as well against peers and so forth. Now, then the leverage ratio just carries across as the leverage ratio. But if I take that return on assets and I adjust it a bit by subtracting off interest expenses, then I can take that difference between the return on assets and interest. I can multiply that times the leverage ratio, total assets divided by total equity, and the result is another major profit metric that we use, and that is the return on equity. So the return on equity is the actual amount of profit that we're getting back from the money that we as owners put into the operation. It's a very good measure to also compare to what we could be doing in some other industry or some other business or some other investment. So the value of the DuPont system is we can use it diagnostically. If the return on equity, way over on the right side of the visual, if it's not where we want to be, then it's not there either because of leverage or because the return on assets is too low. And if it's, say, for example, if it's return on assets that's too low, then it can either be too low because the asset turnover ratio is too low, we're not working our assets hard enough, or the operating profit margin ratio is too low, we're not being efficient enough, or of course, it could be both. Now, we could spend a lot more time going into how to diagnostically use the DuPont system to determine management practices that we want to put in place. But I'll leave that to the article that was referenced earlier, and we'll just move on here to show how these are done in the spreadsheet system that we have. Oh, one last thing I forgot is the sensitivity analysis. At the end of all this, we want to make sure we do a sensitivity analysis whenever we do financial analysis, because things change. We might ask ourselves, well, what could change over a year's time compared to our planning that we did in January? What could change by December? Well, production could change, demand could change for the products, inflation could happen. We could have government policy changes, geopolitical events. We certainly have seen a lot of those over the last few years. Weather, disease, and I would have to mention it, worldwide pandemics. Obviously something that was just added more recently as a possible black swan event that could occur. So we want to make sure to do sensitivity as well. And the spreadsheet system does give us the capacity to be able to do that. Okay, what you see before you on the visual is the tab that's called Cost of Production Summary. And remember, look at the bottom of your screen. You see all these different tabs down here that we've been working through on each video. This one is the cost of production summary. Now, there's a lot of numbers there. Let me try to take you through these. First of all, on the left-hand side is the type of cost of production that we're talking about. It describes it. So this first set of cost of production number is based on the accrual income statement. And we have basic cost, which is just those costs that are operating costs that don't include interest, depreciation, and labor, do not include those. Non-basic costs are the sum of interest, depreciation, and labor. And the one that I look at most often, at least to start with, is the one here in line 11 called total accrual expenses. So this includes depreciation, it includes operating costs, it includes interest expenses, it includes other farm and non-farm costs, and even taxes that I have to pay. So this is the price I have to get for my milk in this case, for this case study, in order to be able to pay for everything. Or if I was doing with corn, what do I have to get for bushel of corn to pay for everything? Below that is some cash costs of production, if that's what your interest is in looking at just the cash side of things. And there's a few individual costs of production below that as well. So that's the type of cost of production. Column C, where it says total cost, those numbers come from the income statement. So for example, this first line, basic cost, which includes interest, depreciation, includes everything, all cost except for interest, depreciation, and labor. That number comes from the income statement. So those numbers, once you've done the income statement work, they're automatically put there. There's nothing, in fact, there's nothing in this tab anywhere that you have to enter in yourself. Depending on what your commodity is, in this particular case study, we're talking about a dairy. So we're looking at a per cow metric in column D. So this is the cost per cow. We're looking at a per hundredweight. So that's the sales unit in column E. So this is the cost of production per hundredweight. If we had corn, if that was our primary product, these values here would switch to per acre and per bushel. And that switch would automatically happen once you've done your original input information. This thing called per unit EQ stands for unit equivalent. And unit equivalent is a mathematical way to try to make an adjustment for those non-enterprise cost of production. So in this particular case study, the main enterprise we're looking at is a dairy producing milk, but they also have some corn sales. They also have some soybean sales. They may also have some cow sales, etc. And so this column F, unit equivalent, and column G, residual claimant, are both ways to make an adjustment for those other types of enterprise costs. So what you're left with is just a milk enterprise cost in this particular case study. Or if we were doing a corn case study, just a corn cost of production, etc. So in terms of what unit equivalent is and what residual claimant is, I'll refer you back to those articles that we referenced earlier. But in the end, if we kind of concentrate on line 11, total accrual expenses, and look at the ones that have made adjustments, we're somewhere between $18.70 per hundredweight to $19.06 per hundredweight for the methods used. Now, the other one I want to alert you to, and the one that I would recommend as the best one to use, is these ones that are in the salmon colored or pinkish cells. These come from a different tab. So let's look at that. There's at the bottom where the tabs are, there's a tab called estimating cost of production. So I'm going to click on that. Now, this tab, what it does is it automatically carries over all the operating expenses that you had on your income statement. So column D, our labor hired is row 5 here, and that $232,861 that number came from the income statement for the amount of costs we had for labor. And it does the same thing for all the rest of the cost. Now, the next column, column E, is where you have to put an entry in. And what it's asking for is what percent of this total expense was for the primary product that you want to get information about. Again, in the case of this case study, it's a dairy. So we're looking at milk. What are the cost of production for milk? And the user of this particular case study said they believe that about 73% of their total labor costs are for the production of milk. The rest of it is for production of corn, soybeans, and whatever else. You can also see at the top, there's a little bit of a metric given to you. 71% of total revenues came from milk. So that gives you a little bit of a ballpark as to perhaps what the cost estimates would be on average, at least. But however, you can make that change. So some costs are going to be a lot less. So chemicals, for example, this producer decided that only about 60% of the chemical costs used this past year were for milk. Conservation expense, well, that's zero anyway. Let's see if another one, do I have a zero in there? Here's another one for marketing costs way down at the bottom. Marketing costs, $6,000. About half of that was for milk. The other half was for something else. So the user, the producer, has to put these percentages in. Once those percentages are in, the spreadsheet does the multiplication. So now you get a cost of production for just milk based on the percentages that you put in there. And these are all added up. And back on down at the tabs on the cost of production summary, I'm going to click on that. That's what you see in these pink salmon colored type of cells. So when we did all that work, the total accrual expenses that we estimated based on putting our own percentages in there was $18.90 per hundredweight. I'm circling it way over to the right side of your visual. So that gives us probably the most, I would say, the most accurate estimate of what our cost of production is. Of course, the best way to get even more accurate cost of production is if you have an accounting system that separates out those costs to start with. So you don't have to guesstimate as to what those percentages are. But either way, there's lots of information here on how to get at least in the ballpark as to what your cost of production might be. Okay, the next type of analysis then is the DuPont system. And the DuPont system is for doing a deep dive in profitability, as our visuals showed before. So down at the bottom, there's a tab called DuPont. So if I click on that DuPont one, you can see this figure over here on the left. And that kind of matches up to that figure that we saw in the visual earlier. So operating profit margin times the asset turnover ratio, when we multiply those together, we're going to get to the return on assets. We do an adjustment for interest on that to get this adjusted return on assets, if you will. We're going to multiply that times the leverage ratio, and that gives us the return on equity. And we can now follow this back. On the right side here, by the way, are some pieces of information that might be useful in evaluating the interest and the leverage, and down towards the bottom, the return on assets and the asset turnover ratio, et cetera. Now, if we look at this quick, we obviously are not happy with the negative return on equity. We can't do that for very long. It's going to happen sometimes, but we don't like it. But where did it come from? Can we diagnostically work our way back and decide what kind of decisions we should work on tomorrow after breakfast? Well, if we look at this, the return on the leverage ratio is 2.134, but that comes back to a more recognizable metric called the debt to asset ratio. The debt to asset ratio is 53.1. If we look down here, the debt to asset ratio of 53%, that puts us in the yellow range. So that is not really a terrible concern. We're kind of in mid-yellow there. I wouldn't say that is a big reason for our profitability challenges at all. So let's look at return on assets. Return on assets is 1.6%. Most of the assets are owned on this farm. So we're going to look at the metric where return on assets is primarily owned, and 1.6 puts us into the red. So that's not a place where we want to be. So the question is, why? Is it because we're not working our assets well enough? Asset turnover ratio? That's right at 28%. Well, an asset turnover ratio of 28% puts us in about the middle of the yellow range for mostly where assets are mostly owned. Operating profit margin ratio, the efficiency ratio of 5.7%. We look over here on the right, 5.7 is well into the red. So I think we've isolated the challenge. It's in the efficiency of our expenses. So how are we using our inputs? Are we being wasteful with our inputs? Can we do some best practices that maybe conserve on our feed so we don't have so much feed wastage, et cetera, et cetera? That could be one thing. Are we paying too much for our inputs? What's going on? What can we do to change that starting tomorrow? So that's a way that we can use this DuPont system to analyze our financials and really give us some insights on management decisions to make. Okay, the very last one that I want to discuss with you is this tab called break-even sensitivity. So this is a tab that sort of allows us to play a little bit of what if. Now, what you're looking at is a table that has primary sales units produced. In this case study, that was milk. So on an annual basis, we produced 51,000 hundredweights of milk that we sold. Our cost of production, our accrual cost of production totaled 965,688. That's in the green shaded cell here. And together, our break-even cost was $18.90. So if we get a price for our milk that's greater than $18.90, we'll make some profit. Right now, our profit goal is set at 0. So just to break even, we have to get $18.90. If we say, well, wait a minute, I don't want to just break even, I want some profit. So let's put $75,000 of profit in there. If I put $75,000 in our profit goal and hit enter, as I hit enter, watch what happens on this green shaded cell here for what price I need in order to get that 75,000, and it jumps to $20.36. So we can play a little bit and see what the impact is. Now I'm going to put this back to 0 for now. The other thing we can do is look at, well, what if I reduce my cost of production? And it's not by a dollar amount, it's by a percentage. So the only cells you want to enter any information into are the yellow shaded cells. So let's assume that I want to check what would happen if I reduced my cost of production by 2%. So if I'm at the same amount of production in this row where the 51,105 is, and I follow that across, then if I reduce my cost of production, now my break even is going to be $18.52 instead of $18.90. Well, I'm not only going to reduce my cost of production, I'm actually going to increase my production per cow by 2% as well. So I come over here on the left, I put 2% in that cell, and that shows how much more production I would get, 52,000 hundredweights now. I follow that across to 2% less cost of production, and now I only need $18.16. So it gives you a range, and I can change this range. You know, I can make this -5% and make this -10% in terms of reduced cost of production. And you can see what it does to my break-even analysis. So it's kind of a way to play what if in terms of the impact on your operation, given that you can change cost of production, given that you can change production itself, or both. Well, this concludes the series of videos in how to construct your financial statements and how to analyze those financial statements. A lot more information, of course, but these videos have hopefully helped in being able to use this particular spreadsheet system. If you do have questions, there is my information that's on the visual that's shown, my email and my phone number. Please feel free to use them if you have questions or want to follow up with anything. Until then, best wishes and thank you for listening.